now in hindsight of all these stocks that are down so big off their highs?
This one right here, or just the simple rule of avoid anything that's not in a stage 2. And Mark and I were talking about this offline, and I was speaking with a friend of mine who attended last year's Master Trader program, and he basically said, if I had only listened, to this rule in terms of just avoiding names that are trading below their 200-day or aren't in stage 2s, it would have saved me so much money. And look, a bull market, eventually gets enough people lazy, and they think, to Mark's point, we made in an earlier section, no, I guess these stocks can't fall, or they can't have long downtrends. And all that is nonsense. These stocks at the end of the day are pieces of paper, and they can absolutely go to zero. Regardless of how good the company is now, and we're going to show more examples, but this past 12 months has been a really, really good lesson for a lot of newbies and, sort of amateur type traders. You can't learn this fast enough, in my opinion. You have to get this. The idea of non-negotiable means it's non-negotiable. So when we get questions all the time, what do you think of XYZ stock? And usually we've never heard of it. We already know it's probably trading below the 200, so we haven't even seen it. And our process is, set up in such a way that we're not even going to see a Valiant when it loses 90% of its value most of the time.
That's right. And again, you may get stocks that can go up, from downtrends. However, what you're going to guarantee yourself, if you're buying stocks in downtrends that are below the 200, that are in stage 4, you're going to guarantee yourself to be in the big giant losers. And if you're buying the stocks that are in uptrends, you're going to guarantee yourself to be in the big winners at some point, because that's where they make the big move. Now, going back to Mark, we started this all off, and he just said non-negotiable, why it's non-negotiable. We started this off talking about non-negotiable criteria. See, this is criteria that is absolutely, some things that we're going to talk about, there's some gray areas, and it's going to take, there's subjective things that have to be judged, and your expertise and your skill level is going to come into play. There's other things that are lines in the sand. They're hard lines in the sand. It's black or white. This is one of them. This is one of the black or white. It's either in an uptrend and it meets the criteria, or it's not. And if it doesn't, then we're going to stay away from it. All right. Let me show you a few other examples here. And again, you can see right here, I just pointed out the characteristics that of an uptrend are going to be where you have big volume on the upside, pullbacks on lighter volume. And when the stock is selling off and you're getting those institutions are now piling out of the stock, you're going to see the exact opposite picture, where you see the big volume comes in, and then as it stabilizes and rallies, the low volume, and then the big break, and here comes the volume again. See, those are big institutions unloading. So if you believe in this, institutions are so superior and they have this great information, well, why would you ever buy a stock that they're unloading like this in mass? Anyway, let's move on. So back in around the 2007, going to the 2008, the subprime, the big debacle, the banking system and so forth, the financial system was in a very bad shape then. We had a brutal bear market. So many people got caught in the banking stocks and got caught in these financial stocks, and like recently, they thought they were safe in a Citigroup, like someone thought they were safe in a Facebook, but you had such ample warning. Like, so many people said that this came out of nowhere. I got caught in this big decline, when actually the writing was so on the wall. But a couple of things I want to point out. One is that you can go from a stage 1, and then you can start morphing into stage 2 and not really get into a stage 2. All right. To really get into a stage 2, you not only have to get up where you're above the 200-day moving average. And again, I'm going to give you the criteria. Some of you already know the criteria. It's in my book. This is no big secret here, but it is the starting point. To get that stage 2, you want to get into the uptrend and then a pullback, and then stair step yourself higher, which this never happened here. And sometimes you'll go from stage 1 right into stage 4. Which you can look back and maybe in hindsight, it looks more like a stage 3 if there's a previous advance, maybe not, maybe it's already down a bit and it goes even lower. But the bottom line is you didn't transition. See, this was Citigroup, and it failed to transition. It started turning up here, and it came out of a really nice big base. Now this is looking like a buy right here, but now you've got to change when the stock changes direction, you've got to change direction. Now, I often say, The stock market, the stocks are an engine and I'm the caboose. It's like a train. I just follow. I follow where the engine goes. I'm not trying to predict. Well, here you come off, you're only off. If you bought this breaking out here, even if you paid up for it and you bought up around 55, you're down maybe, 10% or so, 8 or 10% here. You don't have a very big loss. And it breaks. It's clearly in a stage 4. And look at this stock. Some of these stocks, AIG, they went to 0. Now, these were, again, Citigroup, Bank America. Now, here's where one that Bank America is in stage 1, is in stage 2. This is a confirmed stage 2, but very short-lived. It very quickly morphs into stage 3 and then breaks down into stage 4. Again, these are the points at which if you had bought this stock, you certainly would want to be selling at these key points as you're taking out these lows and you're below the 200. If you didn't sell in one piece and have a stop loss, you certainly, as this is worsening, you're cutting back your exposure until you get into cash here. Now, some stocks will go from stage 2 to stage 3 or 4, and they become shorts. We're not going to talk about shorting anytime during this whole seminar, workshop, are we going to get into shorting? The reason why, okay, is because number one, I'm not that great at shorting. Okay, I would say that, if I were to grade myself on shorting, it's not my best my best attribute in trading, because quite frankly, I don't do much of it, and there hasn't been the opportunities. When you go back and you look at history, bull markets are much longer than bear markets. There's a lot of more risk with shorting. There's limited upside, which is downside with shorting. A stock can only go down 100%. Amazon went up 80,000%. So you don't have that opportunity. And recently with Reddit and all these crazy things where you get rumors and stocks can gap up, the losses could be astronomical. But the real reason is because what I found is it's unnecessary. It's just not necessary. There's so much opportunity on the long side that you don't really need the short side. However, we do recommend to our clients sometimes some shorts, and there's opportunistic shorts, and sometimes a stock that was previously in a stage 2 and I either bought or I recommended or both turns into a short. And so, and this was a real life example. I bought this ANAB coming out here. You can see it's in a very strong uptrend. I sold it here, pretty quick, quick capture of a move. Way later, after it goes into stage 4, I'm actually adding it to our short list right here. And then you see you get the big break later on. But so this is where you go through that maturation cycle. And yes, you can play various parts of the cycle. The two parts of the cycle, if you want to call it the head and the tail, would be the stage 2 uptrend for longs, the stage 4 for shorting. The areas that you want to avoid at all costs are stage 1 and 3, because that's where you don't win on either side. They just move back and forth. Unless you're a real short-term trader, you're going to get whipped all over the place. So stage 1 and 3, you got to be really careful in. That's why if you can identify 2 and 4, 4 you completely stay away from, 2 you want to be in, the other 2 kind of surface on their own. You sort of see the contrast there. You can Amgen, I'm sorry, I'm on Amazon. Amgen back in the 90s had a very strong stage 2 uptrend, went into stage 3, and then it reasserted itself and went into another stage 2. That can happen. Just because a stock goes into stage 4 doesn't mean it's over forever. You can go through a stage 1 and rebase, but what normally happens is when you get into a bona fide stage 4 and you have a big break in the stock, it'll usually be a number of years before you get back into a stage 2. Usually it's 2 to 5 years minimum, and sometimes decades, sometimes 10, 15, 20 years. Now, the other thing you'll find is a lot of times when you get a stock that breaks, you'll all of a sudden you'll have analysts and brokerage houses, and you'll get Morgan Stanley put it on their buy list. It's undervalued. This is where you got to just ignore this stuff. All right, upgrades and all this stuff that you get from it. This is what we're going to show you on how to think for yourself, and you won't have to rely upon any of this crap anymore. That if you went back and you looked at analyst upgrades and downgrades, you'd be amazed at how horribly wrong they are. This is just an example of a stock that we put on short alert. After it was stage 3, it started breaking and it looked like it was entering into stage 4, had a little rally, and right here, Citigroup upgraded it to a buy. 3 days later, the stock implodes down 23%, and you're in a clear stage 4. And then, more buys came in. It was undervalued. This was Chipotle. Again, stock was growing. Now it breaks. They're looking in the rearview mirror, looking at the growth rate. And now with the stock down, it looks like a value. No, the stock's discounting. And you see here, look, breaks again, big break here. This is all the big selling coming in. So you're going to see the same thing. This is something, serial gapper. We call them, once you go into a downtrend, what you'll see is you'll get a lot of unhappy surprises. You get a lot of downside gaps. This was when cores topped. When it broke the 200-day, closed below it, we put it on the short alert list. And look at all the gaps. And this is what I gotta give David Ryan credit, because this is his term. He called them serial gappers one year, a long time ago, 6 or 7 years ago, in the Master Trader program, and I've been using it ever since. This is where you want to be aware of these serial gappers. And when you're in a downtrend, you're in a stage 4. That's where you're going to get the serial gappers. In the stage 2, you're going to have the opposite. You're going to get those happy surprises. Okay. All right. So we're going to wrap this up. Also, I see we didn't put it in earlier, but every year at the Master Trader program, and I know Mark just alluded to that. By the way, just want to let you know your name is Trisha, and we got to change that. I think you're on your wife's.
I am.
He's not Trisha. It's Mark. It truly is Mark Ritchie, but his wife is anyway. So this little gold nugget here, I think we added it on some of the slides going forward, because Bob Weissman, who moderated the live, the in-person Master Trader program for a decade, from the very first one, if you remember, Mark, he'd say golden nugget. When I start to talk about something that he thought was really important, he would say, everybody, golden nugget, golden nugget. And it turned out to almost be a joke as we went on throughout the years. But we put in some golden nuggets here to show you some of the areas that we think are very important, that we're talking about here. Why do we want to trade with the trend? The saying is, the trend is your friend, right? And what we're talking about is a stage 2 uptrend, which the next slide gives you that criteria, and I'll talk about it with you in just a second. One, it's going to increase the probability of your success, of finding a stock that has the potential to make a big move, because 98% of big winning stocks started their big move after they were in a stage 2 uptrend. So right there, you're shifting yourself to the 98% club, right? You don't want to be in the 2% club. It's giving you evidence that institutions are buying. And I'm going to show you later on why it's so important that we want institutions in the stock up front. Before we get in, we want the institutions already coming into the. We're not trying to predict when they come in. We want to already see that. And I'm going to show you there's a real important reason why, a supply-demand reason why, something that you won't expect of what I'm going to show you. But here's the real reason that everything that we talk about through this entire workshop, the reason why we're doing all this, yes, it works. It's been proven. We've used it for decades. We've looked at it and factor modeled it back. If you want to call it back testing, we don't back test, but we've looked at factor modeling and looking at the biggest winning stocks. The real reason is because it creates reference points. What it does is that we don't know. There's a lot of scenarios that can take place where a stock is in a downtrend and it has a PE of 5 and it's oversold and all these things that I have no idea what the stock's going to do under those conditions, or what it's supposed to do. Like, what would be normal? What would be abnormal? But when a stock is in an uptrend and it's coming out of a particular set of circumstances, out of a base, out of the things you're going to learn from me, I know exactly what it should do and what it shouldn't do. And that's all I need to know. Once I know what's normal and what's abnormal, I know if I should be buying it and adding to it, or if I should be cutting back and selling it. All right. And that goes back to Jesse Livermore. If you go read Jesse Livermore, that little thin book, How to Trade in Stocks by Jesse Livermore, which I love. He talks about don't be afraid of abnormal, of normal price action, but be very afraid of abnormal. You have to know what normal and abnormal is. And I've told this story. Some of you might have heard this, of course, if you came to the Master Trader program before, but I would be remiss not to tell it again for those of you that are new. if you're taking the 605 every day, you're in Connecticut and you're taking it to New York City each morning to go to work, and you're sitting on the platform waiting for the train to come in. You look at your watch, it doesn't come in. It's 6:15. It's 6:20. What would you think? Well, it's late, right? The train's late. Probably be here any minute. Okay. Now you look at your watch, it's 6:45. It's 6:50. The longer it goes past 6:05, the higher the probability that something serious is wrong. I mean, if it's 3 hours later, it's not just late. Something is really, really wrong. Why? How do you know that? How could you know that the time that elapses is increasing the probability that something is wrong? Because it's supposed to come in at 6:05. See, if you didn't know that it was supposed to come in at 6:05, it wouldn't be meaningless. If at 7:50, it wouldn't matter. Nothing would matter. You have no reference point. So you have to have that reference point. This is the most important thing that you need to understand of why, because people say, well, that this stock, was trading at a 52-week low at a low PE. It was in a downtrend and it doubled. Yeah. And that happens all the time. But somebody wins with a pair of twos against aces. Every night at a poker table, everywhere in the world, somebody is beating aces with an inferior hand. But what if you played those hands 1,000 times? Who would you bet on? The guy playing aces and shoving his money in, or the guy shoving in with deuce? And that's the difference. Okay.
That's a golden nugget right there that I often tell people. And what you're going to learn here is exactly that, is how to put yourself in a situation where if you play this out 1,000 times, you're not just ahead, you're way ahead. One of the things I often say is, look, anybody can get lucky. Nobody stays lucky. And lots of people buy stocks that are down 90%, and they double and they flip them out for a gain. But if you buy, again, stocks that are in stage fours regularly, or you use bad criteria consistently, your performance is most likely going to be lousy. And the last point I would add is, I think Mark made a really underrated point on the idea of analysts and other folks and listening to people who aren't trading. I'm blown away by the number of people who do listen to stuff off the TV. If these people were so smart, why aren't they trading? Taking advice from those type of folks is highly dangerous in my mind. And look, performance matters. Your track records matter. And you're talking to or learning from two guys who at least have done what they have purported to do in terms of their actual performance. So look, some of these points cannot be understated, and we call them golden tangents sometimes too that Mark goes on, because there's $1 million, or millions of dollars in some of these nuggets if you really internalize them and make them a part of your process and a discipline that you stick to.
Yeah, one of the problems we have now, in the world is that, or in contrast to when I first started trading, there was no information. All right, I had to go to the library. I went to a local library. I read books that were outdated on strategies that never worked in the first place. So it took me a long time to figure this stuff out. I had to figure out a lot on my own. I didn't have charts. There was no internet. There was no online trading. I used to plot charts by hand on graph paper. When I finally got charts, they were weekly, and I would update them throughout the week and draw little lines and have to estimate. I mean, it was, you wouldn't believe what I went through to trade. Had to call in the trades to my broker, wait sometimes 30 minutes for a confirmation. Spreads were $3, $5, $6. Commissions were $170, $250, $300 a trade. And I had $2,000 in my account. So, again, you would think, how could you ever succeed? But I did. I made money. I built on it. I compounded it and turned it into a fortune. And Mark is a similar story, maybe not as archaic as mine, because he started in a more modern time frame. But again, there's so much information out there from self-proclaimed experts that don't have the history, don't have the performance, that you have to now boil it down to and get rid of all the noise. Well, I didn't have any information. Now you have too much information. Just there's so many self-proclaimed experts. I have people all the time. They comment to me on Twitter and tell me how great they are. And I just say simply, well, you can enter the U.S. Investing Championship and prove to the world and put your money up and show everybody that you're better than everybody else. I've done it twice in 24 years. And so I took that risk. Take that risk, go out there and show everybody how great you are. So if they haven't already proven, that's why Mark Ritchie's here. He's got an incredible track record. He's made tens of millions of dollars starting with a small amount of money. He's walked the walk. He stayed consistently dedicated to this type of style and this strategy now for 13 years. That's why he works for me now. He works with me side by side, and he's here today. He's earned it. And I know you guys know most of this, but let me show you. If you the criteria for the trend template, as I call it, or a confirmed stage 2. The cool thing is MarketSmith, of course, our sponsor, they a couple number of years back put trend templates in MarketSmith that I designed with them that are they're my trend templates, and there's a few of them. On the day that we go over MarketSmith on live trading a day, we'll talk about these and we'll run the screens and so forth. But I'm just going to show you real quick. There's 4 trend templates. The main trend template is the 5 month, and that's the confirmed stage 2, which 95% of every stock I buy is going to be in that trend template. You can find this if you go. There's actually a shortcut that says Open Stock Ideas, and then from there. I'm tucked in here with Bill O'Neill, which I'm honored to be in the same page with him, and you can find my trend template there. Real quick on the trend template, or on the trend itself, confirmed stage 2 uptrend is when you've got the 200 days in an uptrend for 4 or 5 months, and you've stair-stepped your way higher. The 1 month on there is what we call an early turn, and that's where. And we're going to get into this later on, power plays, where those are stocks that explode very rapidly, and they move so quickly that the 200-day and the trend doesn't get a chance to turn up yet from a period of dormancy. And so that's what we use the 1 month early turn template for. And also it just gives you a heads up. You can see sort of what's starting to turn up, and then live with it for a little while and watch it progress to see if it's improving, and you get a little heads up. Another thing, there's a few caveats to when you're looking at these charts and the trend analysis. When you have very large bases, or bases that had a big decline or several big declines, like here, where you've got Netflix, you came off here, you rallied, you came off again, and now you've had a few good sized declines and you've moved sideways for a long period of time. You can sometimes get where the moving averages flatten out for a period during that basing period, and then when they turn up, it's an early turn. You haven't been in it for very long, but you've put a very large amount of time in with the base, and that I would consider still in a stage 2 uptrend, or a stage 1 that you can buy when it just turns into that stage 2. Just a few caveats I just wanted to, because over the years we've had some questions about that. Okay, we're going to take another break. This time we're going to take a little bit longer break. I think Bob is going to chime in and let us know here what's happening with that, and then we'll be back. We're talking about fundamentals, and dig a little bit deeper. Again, we have just given you, I want to make sure you understand that we're still in total perspective mode. We have not even gotten to any tools, any real tactics that are for timing or digging deep forensically. We're about to come down to an overhead view, and then we'll move to the aerial and then a microscopic view. But we've been operating from a satellite view. So again, there's been a lot of information here, and you've probably a lot of light bulbs have gone off, and maybe you've learned some things, but we haven't even scratched the surface. So there's so much more. Stay tuned, and we'll be back. Okay.
All right, guys, that is the stock maturation section. Very detailed, a lot of information, and as Mark Ritchie alluded to earlier, golden nuggets abound throughout the event. Mark has provided the little diagram of a golden nugget there for you. These are the key concepts. Everything is invaluable to learn, but ultimately there are a few points that are really emphasized. That's what the golden nuggets are about. You'll see me sometimes type that into the chat box as well. Can't emphasize those enough. With that said, this is going to be a 15-minute break, and then we'll be back for fundamentals. Let's take that break now.